Happy Wednesday, Traderade members. It's time again for your midweek update with Horse and Mayhem. It's February 8th. We're very excited to be sharing with you some thoughts, some takes, and things we're seeing in the markets here halfway through the trading week, as always. And I got a feeling like this is going to be a good one. I think we're finally getting in our groove. What do you think, Mr. Mayhem?
Yeah, I have to agree. I think so too. And it's really been an interesting week. And I think we're starting to see some signs that maybe things are just getting a little bit tired in this market. And I know you're going to talk about that some more in the technical part, but I wanted to talk also a little bit about what we're seeing in the bigger picture in terms of the options market, in terms of the banking system. I just feel like there are some things that are going on that are unusual, and they paint a rather interesting picture. Remember, when Powell came out last week, he just seemed a little bit nervous, but also he said things that didn't jive, right? One of the things he said was financial conditions have meaningfully tightened. But by any objective measure, when we look at the broad indices, whether it's Bloomberg, Goldman Sachs, or the Chicago Fed Financial Conditions Index, financial conditions have actually loosened quite a bit. And then he also said construction spending would help to drive growth this year, particularly in the first half, I believe. And construction spend fell off a cliff in December. But the other thing was there was just a little bit of a different tact about just how hawkish he was. It felt like it fell back a bit. And I started to wonder, is Powell nervous about something? So I did a little bit of digging and I found some details that I thought were interesting. So we're going to start here. These are some highlights from the Financial Times. I'm just going to read them off as they're written. The financial services industry and many of its regulators will tell you that America's largest banks are well buttressed against a potential 2023 recession as the Federal Reserve raises interest rates to combat inflation. However, the data are less reassuring. The country's 8 biggest banks have a buffer against unexpected losses of only about the same size they had in 2006, as we approached the global financial crisis and the recession that followed. This was a period in which hundreds of banks failed, and some of the largest were bailed out using billions of dollars of federal assistance. These 8 institutions, called Global Systemically Important Banks, or GSIBs, because their size and complexity have an outsized impact on the domestic and global economies, now have tangible capital covering, on average, only 6.7% of their $14.7 trillion in total assets, according to the most recent Fed data. This crucial measure of financial resilience, called Tier 1 leverage ratio, is only 0.7 percentage points higher than that recorded in 2006. So what do you make of that, Horse?
Yeah, that's what I was going to ask you. You need to translate this for the macro morons like myself, because this sounds very ominous. I didn't realize we were just going to jump straight into zero hedge hour here, but
okay.
I'm just kidding.
Hold on, let me take off my shirt so I can be like Tyler Durden here.
This sounds ominous. So translate it, because I'm sure there's others besides myself that are curious about your research here. What does this mean in sort of more plain English?
That they don't have the buffer that they would need if their positions went meaningfully against them. And that's telling us that banks are a bit more vulnerable than we may think. Now, this doesn't mean that we're going to have some kind of stock apocalypse now. What it's telling us is that there's a bit fatter left tail risk, even at a systemic level within the financial system, particularly as we're in this era of rising rates and, in some situations, and we'll get into this more a little later, lowering liquidity. Now, with banks, and I should be able to talk about this far more eloquently than I would because she spent nearly 2 decades in the industry, but essentially they're supposed to have reserves. So if they fall in hard times, if things go against them, that they have a buffer, that they're not insolvent. And there's some signs that there's increasing stress in this financial system. After all, if the big 8 are 6% covered by their tangible capital buffer, what's going on with some of the medium and smaller banks? Are they in the same level of stress? Is it worse? Is it better? That's a question that we need to start to look at, because what we can see when we peer underneath the surface is there are some issues to be concerned about here within the banking system. And so that's what I'm looking at. That's one of the things we see on this next slide. Unrealized bank losses surged in 2022 to higher levels than during the great financial crisis. And we can see it on the chart right here. It's right there, plain as day, that their losses by this measure from FDIC in the third quarter of last year are approaching $700 billion between available for sale securities, things like stocks, and held to maturity securities, which would be things like bonds. So the chart, the chart says a lot, don't you think?
Yeah, I'm still trying to understand from like a trader's perspective here. What does this mean other than heightened tail risk for the banks specifically? So let's translate this into retail, right? I'm a retail speculator, investor, trader. What from this should I take away, in your opinion? What's the big takeaway here?
Well, we're going to get into that, and we'll talk about it in a great deal of detail. But the top level that we're looking at just with this chart and the prior slide is that there's more vulnerability within the U.S. banking system. There's reasons to believe there's likely more vulnerability within the European and in parts of China, the Chinese banking system as well. But let's just focus on the US. That increased systemic fragility does create some interesting motivations to not realize those unrealized losses, right? Eventually you do.
I see I think I know where you're going with this.
Right? I mean, at some point you do have to, because look, there's a mark-to-market rule from FASB. They overlooked the banking system, and there was only like maybe one or two occasions where they've suspended that rule completely. One of which was in March of 2009, when the US banking system was teetering off a cliff, and they basically said, look, you can now mark your assets to make believe. So you can take these mortgage-backed securities that are worth like, 10, 20, 30 cents on the dollar, and you can mark them up to like 70, 80, and then you can bring them over to the Fed, and they'll buy them and liquefy you, and the Fed will hold them to maturity, and will all pretend that they expired in the money, or that they expired at par.
Okay.
And that was that was a fun game, and everyone played it, but that game's over. And you can see on the chart here that the unrealized losses now are much greater than they were before the great financial crisis. Now, granted, the financial system is also a great deal bigger than it was then, but at the end of the day, when you have 8 banks that are such concentrated money center banks, where the majority of the deposits in this country are located, and we know, the FDIC's insurance fund doesn't have anywhere close to the amount of money to insure all of the deposits in these banks. It's something like 3%. Right. So, if there were ever some kind of crisis, it would warrant and probably necessitate a level of coordinated government and Federal Reserve assistance. And so, if Powell's looking at this stuff and he's saying, well, geez, the banks are not well capitalized and they're starting to see some stress, maybe I'll ease off the brakes just a little bit in the meeting, just jawbone sentiment just a little bit differently than what the market was positioned for, going into the Fed meeting and going into the David Rubenstein, interview and prepared remarks that we had yesterday. There was a lot of hedging before each event, right? So there was some opportunity for people to kind of realize that, this wasn't this sort of hawkish Powell that maybe we were anticipating. So we're going to kind of take those positions off and create some liquidity. I think that the Fed is kind of looking at this as a situation where maybe, just maybe, and this is me speculating, so I'm going out on a limb here with my tinfoil fedora, but maybe, just maybe, there's reason for that. Maybe things are significant enough that there's some reason for us to look at the Fed and say, well, I wouldn't say he blinked, but last time that hawk was a lot bigger and stronger. This was like a scrawny runt hawk or something.
Yeah, and this is certainly something, just this chart alone, certainly something they wouldn't want to be drawing attention to or publicizing widely, if, especially to your point, if he can sort of take a little bit more of a dovish approach and potentially, hopefully, relieve a little bit of this through the element of time, right? Is that what you're thinking?
I'm thinking
in terms of what he said his change in stance, right?
Well, so the market after that meeting and before we got that wildly, sort of off the charts great NFP data, which wasn't so great when you drill down, but it was what it was, 518,000 versus a consensus of less than half that. But before that, and really after Powell's press conference, the market was pricing in 2 cuts before the end of the year. And one was going to be in September. So it's a 25 bip cut there. There's a 25 pip cut at the end of the year, and they were repricing a terminal upper bound rate of 5.25, up from 5%. So it's basically pricing in, a little bit more hawkishness, but also, more relief towards the end of the year. And you got to ask yourself why. Right? I don't think the Fed's going to cut for fun. I don't think they're going to cut just because they think the inflation battle might be over. I think the market kind of pricing in a pivot because there would need to be one. And there's reasons for that because the market participants in the market know that they're also in some degree vulnerable. I mean, this is not only public data, but if you're sitting at a large money center bank and you have large unrealized losses, you're in a bit of a spot of trouble, as you might say. Now, I would say that might have given the Fed a little bit of pause to ease up, both at that meeting and here's the really telling part, during Powell's interview with David Rubenstein, as well as his prepared remarks before the Economic Club of Washington, D.C., he didn't change his language about the labor market at all, which I found very revealing after that NFP. And then he just sort of tried to minimize it, saying, it's just one data point, when the whole shtick of the Fed has always been we're very data-driven, and every big data point has mattered to them. So it was just interesting to me. Yes, they do want to see trends. Yes, they're concerned about the bigger picture, but that was such an outlier type of reading that fact that there wasn't even a slight change in posture. I found it interesting. Maybe the market rallied on the fact that they like that he plays guitar and rides a bike. I don't know.
Yeah, he did definitely seem a little bit more jovial and personable yesterday, but I don't think that that's really the focus of this. If I'm not mistaken, I think you're going somewhere else. Am I correct in saying that? Because I think what you're setting the framework here is that this might cause a change in behavior in terms of how some of these institutions transact.
Yeah, I mean, I think
am I getting warmer?
You're definitely getting warmer, right? So, with the unseasonable lack of winter coldness that we have around the country, that's good, right? We're getting warmer here. So let's look at the next slide that we have on the deck. And that is the lender of last resort has begun lending. So this is the U.S. Federal Reserve's discount window. And you can see the last two times before the present that this thing was getting any demand were not exactly great times for the banking system. The first one's the great financial crisis. The second one is the COVID crash. Now, I'm not suggesting that we're heading in that direction, but I am illustrating that the risk is rising. And the only reason that financial institutions will borrow at the discount window from the Federal Reserve is if they're having a liquidity issue. This is frowned upon. And when people start to see this type of activity, usually they try to identify the bank in question as well. But I think there's a plurality here. And it's a slow and steady grind higher. So that much is at least to be slightly encouraging, maybe, but we saw that leading up to the great financial crisis too. COVID's crash was straight vertical because the entire economy shut down. Yet the great financial crisis, there were signs along the way. And so maybe this will look sort of like a hybrid between the two if it does turn into a tail event. But the basic notion here is that there's increasing distress in a financial system after nearly 13 years of constant emergency level stimulus. But we are seeing signs that the Federal Reserve has been providing so much stimulus to the banking system that zero interest rate policy and the idea of sort of constant liquidity flooding in, or at least it being on tap if the financial system needs it, that helped to juice one of the best bull markets that we've ever seen. And it was really a multi-asset bubble. And on the other side of that, when you start to see that liquidity taken away, when the cost of capital rises, when a lot of assets had really a rough time last year, you see an increase in this type of borrowing. And I think that's just telling us that underneath the surface, not just with the Financial Times research and what we saw with unrealized bank losses, there's some other plumbing here that suggests that indeed there are some problems underneath the surface with the financial system. The next chart I have here is financial conditions have been getting easier. So this is something that we talked about a little bit earlier on. And I just want to drill down into it because when this index is higher, conditions are easier. When it's lower, conditions are tighter. And what it's looking at is stocks and bonds and various other credit mechanisms. It's just basically getting a sense for how available money is, how available, and how assets are performing and things like that. Now, at the end of the day, the Fed started hiking in March of last year, and you can see when financial conditions tightened during their first hike. We have written that all off completely. So when the Fed came out and said, financial conditions have tightened, yes, you can see it in certain places, right? You can see it in the yield curve. You can see it in M2 money. You can see it in, bank lending standards, the cost of a mortgage, things like that. Sure, it absolutely is a thing. Some levels of financial conditions have tightened. Mm-hmm. But the Fed specifically lamented about financial conditions in proximity to the tight labor force participation rate, whereas so many people had endeavored to get early retirement from rising property, stock, and bond prices, as well as things like crypto. And they were talking about really that they'd need to inflict some pain to get people back in the labor force. Well, what's happened since then and now is that the JOLTS number, which Powell specifically cited in December, 1.7 jobs available for every one unemployed person seeking work, that number has actually showed a tighter labor market. It's now 1.9 jobs available for every one person seeking work. And while the rate of wage growth has fallen a bit in nominal terms, it's actually starting to rise a bit in real terms. But more than that, we have all the signs that the labor market isn't slowing, and that is a big driver of demand. In fact, some of the Fed speakers that have come out recently have spoken with concern about the labor market in particular. So I think it's interesting that we saw remarks from Powell that indicated that, A, he was sanguine about the labor market, even though all of the conditions that concerned him are still present, if not building, and B, that he seemed to indicate financial conditions had gotten tighter when by any reasonable measure, and you can see this in other wide indices of financial conditions as well, they're showing the same. So it does suggest that there's just a little bit more. I didn't expect this from this Fed. I really personally thought Powell would be much more transparent about communication regarding policy, because since the COVID crisis has started, he's been very, very forthcoming. He's spoken plain English, but he's largely, when it comes to policy, not the economy. That's a whole other matter altogether. That's expectations management. But in terms of policy, which is a different type of expectations management in terms of the credibility of the Fed, he had actually been pretty transparent about everything. This is what we're going to do. This is what we're going to do it by. This is the set of variables we're watching to decide what we're going to do. And so this deviation to me is it's different. It's not the Powell that we know and wrote, and I talked about that a bit at the last podcast we did for the last midweek update. But this departure now after the interview that we just saw is even more concerning in lieu of all the data, or in light of all the data.
So obviously Powell wants that figure down, right? Yes. But you highlighted early on there might be some potential trouble in the banking system that he also does not want to bring attention to. So what's a guy to do? What a pickle in this. If I'm understanding what you're presenting correctly, this is a really tough spot to be in, because that number needs to come down. But at the same time, we don't want to put any more stress on the banks. Are those the two things he's having to juggle the most, do you think, right now?
I think so. Let's look at it a couple different ways, right? So on the one hand, they are walking, like you said, this is a tightrope, right? It's an unenviable position to be in. The Fed, the ECB, the Bank of Japan, I wouldn't want to be in any of those places making policy decisions, because you could be wrong on both sides and be right at the same time. You could have your heart and your mind in the right place and you do the wrong thing, and there may not be any great decisions, especially given the lagged impacts of policy on financial markets and even more the economy. But I think that they don't have a choice but to eventually make one kind of policy mistake or another. And I think in terms of credibility and sentiment management, these recent meetings have been damaging to the Fed's credibility. And they've allowed sentiment in markets to get wildly, wildly optimistic about, yes, it's been a powerful leg up, but what has it been led by? It's been led by Carvana and Bed Bath & Beyond and AMC and a whole litany of other bankrupt companies. That this is not the sort of thing that, a real bull market should be built on. And I'm a little bit concerned about some of the areas, like Cathie Wood's ARC up 40% plus year to date. It's without anything to accommodate longer duration risk, these heavy borrowers that don't make any money with the rising rate of capital. Every single day that the Fed keeps rates here, never mind raises them, just keeps them here, more and more businesses have to deal with much higher costs, but whether they're,
I was just going to ask, is it possible, though, that they're playing some 3D chess here and not changing policy, however, using words to try to bring or buy time or let the banks stable out a little bit more. So it's almost like, is it actually an error, or is it what I would do in the same situation if I didn't want to draw attention to potential trouble underneath the surface and we needed time? And with the indices rising, I would think eventually that would change your initial chart with some of that stress on the banks, hopefully being alleviated. So is it possible that the man really is playing 3D chess here by not changing policy, however, switching to a little bit more of a dovish tone because people are gullible, and it kind of brings a little sense of peace and not so much Volcker Powell out, if you will. And I think by seeing the chart where you're going, I think I know where you're going. I'm excited about that, but I just wanted to sort of ask that one final question on maybe the dance that he's doing right now, if there's a purpose to it that is twofold, because we know their words can be just as effective as policy in the short term, right? In their tone, the language they use, their dovish takes, like the policy doesn't have to change, but the words are very effective.
So he's a good dancer, right?
I'm trying to provide a little balance to it, right? Because I think he might be, and we both acknowledge, I don't envy the situation the guy's in. However, one other point I will throw out is that in addition to a lot of junk running, we also can't really deny that there is been some quality running as well. In tandem with that, I mean, some of the biggest companies in the world, mega cap, did experience a nice burst there starting the year. I mean, Tesla, I hate because it's almost blurs the line between a mega cap and a meme stock, but that thing has absolutely soared. Apple has taken off. So it's not all junk. There's a little bit of meat to this rally that I think is different than what we saw in 2022. And I'm not saying it's stable and going to last forever, but at least it is encouraging that some of the larger companies have gone with the junk, even though the junk is what we see the headlines, because like the move in Bed Bath & Beyond the other day, 100, 120% in a day. Like, yes, I agree that is absolutely absurd, but it's not all terrible stuff leading it up. Would you say that's fair?
I would say it depends on how we qualify leadership. If we qualify leadership by just raw percentage gains, then the leadership is really the worst parts of the market, and that's very less than ideal. In terms of the breadth of leadership, yes, there's definitely wider breadth of leadership in this rally than there have been in prior rallies, and there are some reasons for that, and we'll get into some of that very soon.
Yeah, but I'm more interested in what you have on the screen here, because this is where I was thinking you were going, and I'm excited. So keep going with this. Don't let me get your narrative off here. I was just playing devil's advocate a little bit on Powell's behalf that maybe that's what he's doing, and if so, kudos, because like what would I do in that situation? It's a tough line to walk.
Right. And that's why I think it's important that we started this off looking at why this seems so out of character. Why does it seem like he's so uncomfortable and he's changing his own narrative and setting expectations completely differently? Why does it appear to be a potential policy error? Maybe there is something else that's concerning the Fed. And I do think that this is a pretty sophisticated Fed in the way they operate versus what we've seen from the prior several Fed governors and Fed presidents. I think this is a pretty overall, they've done okay. They messed up on the inflation bit, but quite frankly, they felt that they didn't have any choice because they were uncertain of what subsequent variants of COVID would, what kind of economic impacts that they might have. So they kind of leaned off. But basically, what you're saying is it's exactly what we want to talk a little bit more about. So first thing, FDIC will have their updated Q4 unrealized losses chart for the banking system in the U.S. around March 1st. So we'll definitely be looking for that, and we'll be sharing any updates and important details about this with the Traderade family, because we do want to follow this situation. It is an ongoing and developing situation. So we're going to continue to provide research and updates on it as the material that we have is, worth sharing. But yeah, I think there's merit to the Fed playing 3D chess, because at the end of the day, we have a Federal Reserve that is a private institution. The only hybridized part, or government and private, is the Board of Governors. The regional banks are ostensibly banks. And so who do they really work for? They work for the banking system. And so when the banking system's having issues, it is much more likely that the Fed is going to say one thing and maybe do another, or at least be willing to turn a blind eye to some things from some of these industries that they directly supervise. So on screen, we do have this options chart. The options volume for total listed options is getting close to 70 million per day. That's the most we've ever seen. That exceeds the two giant meme stock runs we had in Jan-Feb 2021 and November of 2021. And we're at an all-time high. And this is interesting because during those prior meme stock runs, retail was a larger player than they are now. And yet options volume is, well, quite literally off the charts. And it is going into all variety. You talked about Bed Bath & Beyond and that big 100% rally they had, which was a short squeeze driven by basically delta squeezing on the option side. And that's where folks are buying zero DTEs that are very close to the money and just pushing it up as the price goes up. And if you're exceeding size of open interest significantly, you're kind of encouraging, if not forcing dealers to start to hedge, and they're doing so with leverage. If you're a player buying that option, you're basically using the delta as your multiplier, depending on how the dealer is hedging. They're buying that many more shares, and that's a big deal. If you're buying one contract and they're buying 20, 30, 40 shares per every contract, and then you start to really magnify that effect. And then the shorts on the other side, they don't have a choice. We got a fee rate of 130%. You've got no shares left to borrow to try to push against this buying, to try to push price down. So you get to a point where your risk manager taps you on the shoulder and is like, lighten up. We can't have this thing up 100%. You've got to get, or even 20% or 30%. And these guys are getting out and they're stepping on each other's feet. It's kind of like a crowded movie theater where there's a fire. People are trying to do everything they can. So you get that short squeeze event. So a lot of these single stock options activity in these smaller stocks, the things that have been the so-called leaders, they've been driving this through episodic short squeezes of things that have, float short percentages of 20, 30, 40, 50, 60%. Bed Bath & Beyond was over 50% the other day, but there is a risk. Now, these short squeezes can be very lucrative for short-term, and I mean like intraday traders. I think holding any of this stuff for very long, particularly after hours, is very dangerous.
Right.
And, yesterday, Bed Bath & Beyond came out with a dilutive offering to try to raise cash. And of course, the stock fell a lot. And that's a big problem when you get into these things. If you hold them, they can go against you and you can lose half. Like right as the mania was hitting its heights and a lot of people were getting in, that was when the company said, you know what, we can convert these equity holders into cash, reward our bond holders, and have some more, money to kind of build a longer runway. And that's exactly what they're going to do. Every company that's part of a short squeeze, if you look at their fundamentals, I'd say everyone, if not the vast majority, are in trouble in one way or another. And this type of aftermarket dilution is not uncommon. So just a kind of heads up. But what we're seeing on chart here is part of a larger pattern. The options market has become the tail that wags the dog. And that's a big deal because we're in a market where there is less overall participation in the share side and the ETF side. But at the options level, whether we're talking about the indices, whether we're talking about their relative volume at the options level versus their, futures equivalent, whether we're talking about ETFs or single stocks, options activity is largely well more than it's ever been, and also in relation to volume. The options have become the tail that really does wag the dog. And that's a big deal because you're talking about people that are more sensitive to time. Most of these options are expiring same day. And you're talking about people that, as a result of the leverage, are much more sensitive to price. So this exacerbates volatility. But on the other side of it, there's a lot more going on inside the options market that I think is worth paying attention to here. So let's look at this next chart. With SPX, we have a rather extraordinary chart here. You can see it's gone pretty parabolic since the COVID crash, and it's not letting up. Now, we have more and more expirations from CBOE, so pretty much every single day but weekends, there's expiring options for SPX, and you've got folks that are playing these things in ever greater quantity as a result of that and more. Now, let's look at this chart and talk about it just a bit, because, at the height of the last options, you could call it mania, in SPX, we weren't even scraping 600 billion. And just recently, we got close to 1.1 trillion of notional value exchanging hands every single day. That's incredible. And that's very unusual. And it suggests that maybe, just maybe, folks are looking at the cost of capital and saying, you know what, I can't play that way anymore. I don't want to have a carry cost overnight. I don't want to accrue that cost every single day. So instead, I'm just going to settle up at the end of every day. And we've obviously seen that with day trading. That's how most people do. They flatten their book at the end of the day. But what if larger players started to do that? Because look, at this volume, Horse, I'm sorry, but there's no way this is just folks sitting at home on their couch.
And you can't blame it on the rising value of the index either, because the chart doesn't support that. So you're right. There's and this is something we've talked about a lot, and I'm glad you're finally doing a deep dive on it, because there is something fishy going on. It's not retail that's driving. Yes, retail participation is still at incredible highs. However, the sheer quantity and dollar value tells us alone it can't be retail.
Yeah, and it's interesting because retail's not as big in the options market as they were in 2021. They're bigger in the share part of the market. We'll talk about that a little bit later and what I think it means. But in the here and now, this chart is a little bit insane, because think about it. If you're running a large book and you want to add some liquidity back, you've got a lot of losses on your balance sheet. Well, we talked about these unrealized losses. One way you can add liquidity back and not have to record it is to trade something and have it settle before close. Because at that point, it's just cash. You added some cash. How did it happen? I don't know. The assets, they're great managers. They have really good positions. But in reality, you can push and pull this market around with options. You can push and pull a $40 trillion index around, exchanging 1 trillion of notional every day, or even less than that.
And I think not going to have the detrimental impact that we saw from the initial chart, where these banks are in a tough spot. Correct? That's what you're saying?
I would say that, look, if we are correct in what we are theorizing right now, and for everyone out there, this is Traderade original research. This is stuff that I've been looking at, and I've talked to Horse about, and I've talked to Aisha about, and we've all been looking at this situation because we want to keep you all informed of what we're seeing that's not always out there. And I think it's important because this is something that is kind of important. These guys are able to increase their value of their total cash in these positions because they're basically just growing the cash position of their balance sheet, settling up every day they're profitable. And it was interesting because, last quarter, JP Morgan's trading desk they did really well. And you got to wonder how that is. I mean, it's great that they did so well in quarter four, but I mean, that's when a lot of this stuff really started to go crazy too. And they're one of the biggest banks that trades, in all of these markets. We know how they move the markets. We talk about just how some of their funds move the markets. Imagine how a motivated trading desk of a bank that doesn't want to report these large losses might behave, especially if you add other banks in the same position, whether they maybe know about this or just have decided to do it in concert doesn't really matter. The fact is that enough large institutional players are playing in such enormous size of these options that we can't ignore it. We can't blame it on retail. We know that it's coming from the banking system and the hedge funds, and a lot of them struggled. They had a terrible year last year because every part of your portfolio got wrecked. It didn't matter if it was stocks, real estate, bonds, if you happen to have crypto, any of this other stuff, it was all getting marked down. There was a globally harmonized deleveraging. There was nowhere to really hide. Even volatility and SPX puts didn't pay out the same last year that they had during prior trying times. So what does that tell us? Well, there's some folks out there that really don't want to realize these losses unless they're a little bit smaller. And this could be part of that, because think about the aggregate impact. Not only are you able to raise some cash in your portfolio, in your assets, right? You're also able to push the net price of these assets higher because the market's going up.
I hope people appreciate the theory that you're proposing here, because to me, I think this is the most intriguing explanation for the craze in short dated options, because we got to be honest, everyone's acknowledging that it exists at this point. We're hearing it talked about more and more. And even the fact that, like, I've heard it mentioned and talked about on CNBC, if they're talking about it, then it's a thing, because they're always horrendously late to the party. So it's being acknowledged, right? But no one is actually really trying to figure out why or who. And maybe there's a reason for that, but that's one of the things that is really intriguing to me about what you're sort of painting a picture here. that I think is very, very intriguing in terms of what could be causing this activity. And I've thus far not heard anyone do that. So first of all, kudos for taking the time to sort of connect some dots, because again, just to make it clear, this is a theory, right? We don't have absolute fact, but you're piecing together some things here, some breadcrumbs that I'm finding this fascinating. Sorry, I'm at a loss for words because I'm trying to wrap my head around it. But
it is big, isn't it?
It is, and it's the first legit explanation that I'm hearing about why they would potentially be doing this, because I don't have to add any more losses to my book if I'm settling every day. That is fascinating to me.
So let's put some of the pieces together as we go down this path, because there's plenty more to share. But just for everyone out there listening, if you're not 100% up to speed, we're talking about banks having a large capital loss that they've not realized yet. That means that they know that it's there, but they haven't reported it and they haven't acted on it, right? They certainly haven't sold any of these things. They haven't reported on their mark-to-market values from where they were before. Now, we can see that other companies have, like Blackstone had those REITs. They were underwater on their actual property. That caused them to, as they do at the end of every year, the beginning of the next year, have to mark those down. And folks were gated. They were trying to get out before these losses were realized, and they're going to have to get out at a lower price. So there are reasons that institutions don't want to just report on this stuff. Now, what we're talking about is a Fed that might be saying, look, we can't bail you out directly. The Congress doesn't have any political will to do anything like that either. But if you want to do some things underneath the surface here, maybe we'll just turn a blind eye to it, because obviously they do see a lot more than other regulators. They kind of have their fingers in all of these banks, and vice versa. It's a relationship that's a little incestuous, quite frankly, but it is how it works, and it's how it's always worked. Now, if you are a bank and you're trying to gain funds back, and you're trying to do so with leverage, you can't put that stuff on the books overnight for a variety of reasons. One is it might not fit your risk parameters. And that's one of the reasons I'm saying maybe a little blind eye is being put on here, because this sort of stuff might not fit your risk parameters for anything that's being recorded. The other, though, that's really important is the compounding effect of rising rates on any kind of leverage. The cost to carry has risen so much since the Fed started hiking rates. And we've seen that globally harmonized deleveraging. One of the reasons that people are just selling everything, not just inflation, but is also that the cost to have it in your portfolio with leverage that everyone was using for over a decade, that's gone up so much it's not worth it anymore. The market was so volatile last year too, so people are just like, I'm not going to sit here and pay 5, 10, whatever percent to hold this stuff that's killing me anyway. I'm going to start to de-risk. And we saw more and more of that. It's very typical during a tightening cycle to see that. Now,
hence what makes these shorter dated options so attractive.
Exactly.
I don't have to carry that. I don't have to hold that. I don't have to pay that.
I don't have to report that.
I don't have to report that. This is really good, man. This is good.
And so the short-dated SPX volume as a percentage of total volume is creeping well above 40%. By some measures, it's hit 50%. But this is a really interesting chart because, look, as rates rose, as the financial system tightened, this percentage, not just the total volume, but the percentage of that total volume that was just this stuff, has surged to levels that there's no other explanation than large institutions using this as a mechanism to reliquify themselves, because a lot of this volume has been on the call side. Yeah, we have episodic put days, and sure, that's certainly something that we can take into consideration. But the vast majority has been call-driven delta squeezes, calls that are expiring in 6.5 hours or less, that are right close to the money, and they just push these things up, one strike after the next strike after the next strike, and you can see it in the chain. You can just pull up the chain. If your broker lets you look at SPX options, you just pull up that expiration for the same day. You might have to set it to view weeklies, but you look at that same day expiration, and you will see this on pretty much every green day. Especially the ones where you're like, wait, how is it green today with everything that's happening? Like Microsoft reports terrible earnings. Market's like, don't care, running higher. And You see this stuff underneath the surface. And it's like you used to say, Horst, you're like, I hope the S&P does what I love for it to do, where it just rallies for no reason at all. And like, that's been a big driver of this, is this like, okay, often is the case, not always, but often we can find some narrative or some reason that some of these things are happening. But sometimes it just comes down to stuff like this, especially over the last 6 months, and very especially really over the last, month and a half that we've seen this year. This has been a market that has had these sort of episodic delta squeezes at the index level and at the single stock and ETF level. And it has thrown a lot of things sort of off balance, but it explains some of the things that we're seeing, especially in some of the more battered down assets, and why they're outperforming. Because if something's heavily shorted and you attack it with calls, zero DTE, close to the money stuff, you're going to force those shorts out. But even with a $40 trillion index, if the biggest players on the planet attack it with zero DTE, close to the money calls, the amount of leverage that creates to have dealers buy the underlying, or in this case, S&P E-mini futures, it's extraordinary. There's never been anything like this ever.
And I think what's interesting about it too is I think a lot of times this squeezy price action is associated with the retail thinking things like, well, we're sticking it to the man. Right. But in the reality, they're also making a lot of money doing this, right? Occasionally you're going to see actual liquidations and blowouts. I would guess somebody got very hurt on Bed Bath and Beyond the other night.
For sure.
So there are losses that can be, devastating for some of these larger institutions on things like that. But in terms of doing this with SPX and the index futures, I would think retail is greatly misinformed if they're assuming that these large institutions are taking baths on this stuff because they're squeezing, when in reality that's just not the case at all. They're often making tons of money as well because they're hedging, right? They're not playing it the way that retail is playing it, which is, solely directional with a little bit of prayer and heavy drinking mixed in there. They're a little bit smarter about it, right? So it's entirely possible to be turning a profit. And why not continue to do it? If I don't have to hold, these realized losses, I don't have to pay the cost to carry. Why not continue doing it if it's working for them and it's profitable? That's, I think, kind of the scary part. Like, just because I see the last bar on this chart at an all-time high, I don't necessarily know that doesn't mean this can't go higher.
We're in an uptrend.
What I mean? Yeah, I mean, clearly, TA-wise, this is at an uptrend. But you get what I'm saying. And I think it's important for people to understand that Mayhem presenting some of this research does not mean that this is the turning point. It means that this is a pretty interesting theory on why this is happening. It does not have anything to do with the end of it. Where it ends, I don't think anyone knows. I do think everyone would agree it probably wouldn't end well. But in terms of like saying when this behavior would stop, that's completely outside of the scope of this.
I have a random guess. I'm just going to put it out there. It's not a prediction, but I'm just going to guess between Feb and March OPEX. Just guessing. Could be completely wrong, but we've had some of the most market turbulence between that window in prior times. And Jem has spoken very eloquently about that. And he has some theories and historical analogs and seasonality about options positioning to kind of back that up. So it's probably on his Twitter feed somewhere. But in essence, we're not making a real prediction as to when this ends. I think what you alluded to is how it ends is probably not well, because a lot of folks believe this is a new bull market, that we've turned the corner, that, this is sort of like the end of the bear cycle. And while that is a possibility, and we can't discount that as a possibility, it's a very unlikely one with history as our guide and just with valuation as our guide. We're going deeper into our earnings recession, and the S&P 500 is rallying. We see people deleveraging and taking off positioning, particularly at the institutional level, and we see the market rallying. We see a lot of things that are a little bit disconcerting where we are, and it's a departure from reality. Now, that doesn't mean it can't go a lot further, but what it does mean to me, given what's driving it, is that the downside risk is being amplified the further we get stretched from a reasonable valuation or from a reasonable price for the overall market. And what do I mean by that? Well, let's look at some analogs just in the options market for a second. Tesla is one that comes to mind, Affirm, Asana, Cloudflare, a lot of these, even Upstart, which I still don't know what they do.
I don't know what they do.
I have no idea. I can't hear you right now.
I can't hear you.
I
You're
can't hear
breaking
you
up
either.
too.
What's happening?
It's weird.
So basically, like, where we are right now is a point where we're seeing this pocket of hot air underneath the market, and it's helping some of these players, I want to say, and we'll see as we get more information from the banks, from FDIC and other sources, whether they are starting to de-risk in that. But that's part of my theory here as well, is that maybe some of that de-risking has started, or will start soon.
Well, I think in addition to that, I think there's two things I want to add on that before we kind of, as you bring this to a conclusion. There's two different endings that are worth calling out separately. There's the ending to the zero DTE craze or strategy, whichever side you're on, whether you're, someone that's observing this madness or you are the institutions participating.
Yeah.
There's the end to that. And then that's different than like the end to this potential uptrend that we're in right now, because weaponized gamma works in both directions.
It does.
They can continue to do this on the put side and have the market sharply decline.
Yes.
But that doesn't mean the zero DTE behavior ends.
No.
So I think they're two separate things. I'm more interested in like, well, okay, what causes that actual behavior that the banks are, according to your theory here, potentially participating in size? What causes the end to that? And what does that mean? Now, the reality is, I don't know. Maybe you have some thoughts on what causes the end of that, but I do know what it would mean in terms of practical terms. You would see spreads widen. You would see retail not get the hint or the clue and probably still participate heavily and end up the losers in that exchange. Because if they're not as engaged in the zero DTE craze, by they, I mean the institutions here, obviously spreads are going to widen on those, but retail's still going to probably play until they've had their hat absolutely handed to them once they realize that, that the spreads and the fills are not advantageous to turning a profit with that particular strategy. So either way, I don't know how it ends in terms of what causes the institutions to stop, but I do know it likely ends in retail getting really hurt if this is, your primary strategy.
Yeah, you can always get back to the sort of buy the dip mentality, but what if the dip just keeps dipping, right? So I think that is a good question. How does it end? My thought is that it ends around the same time that these banks don't have to realize extraordinary losses. Right. Where they're like, okay, you know what, good enough, because this can't go on forever. I mean, they can do it for a while, but eventually, it gets heavier and harder to keep lifting the market. More people are going to be de-risking into this stuff, because there's another factor here too. There is a sort of generational rotation that's happening right now, where retirees have lived in a world of financial repression for so long. And there's so many juicy opportunities in fixed income and dividend stocks as well, but particularly fixed income, that there's no reason not to rotate out of risk on one of these types of rallies, say, you know what, I really didn't like the market last year. I didn't like how I got beat up on all my equities. My bonds got a lot cheaper, but I'm still attracted to the idea of low risk or risk-free returns. And so I'm going to just add to those positions. And I'm hearing there's a lot more of that the 50, 60, 70, 80-year-olds are adding more and more to their bonds and getting more and more out of equities. Now, we'll see if that's anecdotal or not. I've only heard that from a couple of managers, but I think that's another thing to reckon with, because on the other side of it, where are the folks to replace those funds going into equities from the retirement system? We obviously know the top 20% of Americans own a whole lot, most of the stocks in the country, but there's still a pretty important amount that are owned by older generations as well. And if they're de-risking and younger generations aren't contributing as much, if at all, to their retirement because of the difficulty dealing with inflation, that does create a little bit of a quandary in the here and now. Now, that's a quandary that may be eliminated if we get back into a easing cycle, but in the here and now, there are some natural forces that are leaning us more towards the idea that at least there's a portion of capital that is heading out of stocks and into other things, whether it's a Treasury money market account where you get over 4% yield, or looking at creating a bond ladder in various types of bonds and various durations.
Interesting.
So retail options participation as a total activity. So of all the market activity that's happening, it's dropping. Look at last year. Look at what we saw in January 2021. Look at what we saw in November 2021. We could see that retail options activity spiked. What else happened then? Well, that was pretty much an interim top in the retail favorite stocks. We're not seeing that this time. And the reason that's important is it's not retail really driving this thing. Not that they were ever in the driver's seat to begin with, as you can see on this chart. Mm-hmm. But now they're even less involved. We have record options volume. We have record amounts of options trading for single stocks, for ETFs, for indices, record amounts of premium trading on SPX. And where's retail? They're not even, I mean, like if you adjust for the difference in options trading from 2021 to now versus this chart, it's like retail barely even exists.
But they're the scapegoat typically.
Well, yeah, everything's their fault when the market goes down or up in a way that, is unpleasant to a narrative.
Right.
But this is a problem because, I don't think that I don't believe that this time is like what we saw in 2021 for a different reason. I think there's something else kind of going on underneath the surface here. I believe that retail is getting into a position where they're actually being used for exit liquidity because they're not big players in the options market, but they are bigger players in shares, and we'll get to that. But I just wanted to bring that up because that's a concern. If these folks are really going to get hammered, it's going to happen.
So I got the dumb question though, because you've laid this out in a very linear way, and it makes a lot of sense. But then it sort of begs the question: who are the large institutions buying or selling these things to?
Yeah.
If retail's participation really hasn't changed, yet we see the popularity of short-dated options absolutely through the roof.
Yeah.
Who's on the other end of that trade?
You got dealers. Those are the ones that are hedging and driving the market up so they can be delta neutral. It becomes a sort of self-perpetuating cycle, a self-fulfilling prophecy. If you're going into an option in size and you're driving price, you're driving it because the dealers are hedging, and they're hedging so that they can return to you, the amount of capital that your contract may have appreciated. And they do that through the gains from those hedges that they use to become delta neutral, right? So if the institutions on the one hand are buying, market making components, some of which are part of institutions, some of which are separate from the institutions that are buying, right? They're buying the market and they're pushing it up and they're realizing gains, and it kind of just feeds on itself. It kind of goes, if the party goes on until it stops.
But I think that I asked that question for a reason, and I think it's super important to keep it in context for everybody that struggles with the market when it gets disconnected from the economy, or the market when it gets disconnected from the broader macro outlook or what the Federal Reserve's policy currently is.
Or fundamentals.
It's entirely possible that trends like this can continue. Things that are crazy can continue to get crazier because we've seen from the chart, retail's participation is not necessarily needed, right? And you just reiterated that their level of engagement with options hasn't really changed sustainably.
It's dropped.
Right. So I think it just goes to show, though, that it's not these are not the people that are struggling, burdened with credit card debt and all the different, macroeconomic factors that we could take into consideration. We're talking about completely different, sets of the population. I think that's key for people to understand. When things get disconnected, crazy can get crazier because the folks that are utilizing strategies like this, trading in this volume at this level, they're not the people that are worried about making their next car payment. You know what I mean? We've already seen that it's not retail. So crazy can get crazier, I guess, is the point that I'm trying to make. If you take retail out of the equation here, which I think you've done graphically, this is why these disconnections can happen, and why we say over and over, and everyone does, the stock market's not the economy, because you have essentially the wealthiest in the world gambling. Who am I to get in their way or predict when that's going to stop?
Well, it also just really starts to beg questions about what really happened in 2021, because the idea that was all retail is, we can see in the same charts, is patently false. Even during the peaks of options mania, they weren't accounting for more than 18% of total volume. So it's obvious there was a lot of other stuff going on during that period. And if you think about it, if you're an institution, and we can even do this with FactSet, you can go in and you can look at the short interest of stocks, and you can look at their float, and you can look at their options chain, and you can get an idea through an automated scan which are the best targets for a delta squeeze? Where can you get your biggest bang for your buck if you're going to throw $100 million of calls into a stock and hope to 10x yourself? And you could do this, and there's no reason that these guys wouldn't do this sort of thing. And maybe that's more of a hedge fund game, but the type of options volume that we've seen is very suggestive, given the portion that is institutional in nature, that a lot of this stuff, not just the here and now, but even some of the nonsense we saw in, Jan, Feb 2021 and November 2021. Sure, retail was a part of the GameStop squeeze or the AMC squeeze or all that, but they weren't the primary drivers. I mean, there was much more institutional participation in that stuff than I think people realize. So the narrative of sticking it to the man, I mean, most of the world is long. So, you know what I mean? Like, what are we talking about? Who are we sticking it to?
But that's good perspective here, though, right? Because these guys playing at these levels, at these desks, they're not motivated by a fear of loss. They're primarily motivated by a fear of missing out on a rally. That's when you get your hands slapped. If you're not in and making money, then you're in serious trouble. So there's motivation on their side as well. That doesn't, I would say it differs from retail's motivation, right? Yes, we're all motivated by wanting to make a return, putting on a good trade or making a good investment, right? But we don't necessarily have that. Yeah, we don't have that same amount of pressure. Like people don't get in trouble for taking stops at this level. They get in trouble for missing the entire rally.
Yes. And they even lose clients and otherwise, depending on what kind of position they are in the financial system. I mean, you absolutely have to be, in a market, especially in these long only shops, you have to be participating. You take your licks when things are down. But I mean, a lot of these shops even have, if you're talking about the money management side, they have requirements as to how much capital is supposed to be deployed in various assets based on their prospectus, based on the promises they make to their clients. So, this is a chart of Tesla. Oops, I'm going to bring that right back. This is a chart of Tesla, and options volume in Tesla on some days has exceeded 7% of all options volume.
That's insane. That's why I said it sort of blurs the line. It's hard because it went from meme stock status to included in the indices and, more blue chip than I would have ever hoped. But here we are. It's basically the world's largest meme stock. It definitely
it's pretty much what it is.
Blurs the line between, a mega cap stock and one of these little low float penny stocks that moons.
But, the interesting thing about Tesla is a lot of the theories that we saw passed around on social media was this is like a short squeeze. The short interest on Tesla's float is minuscule. It's trivial. It would have little impact on price discovery if everyone rushed to the exits at the same time. But the call buying is extraordinary.
Right.
And that's where the price action is being driven. And a cautionary tale, if you look at those last spikes, those were November 2021. We know what happened next to the stock. So I get that this is exciting, and yes, it can keep going for a while, but do be aware this is building a pocket of hot air that could be retraced violently.
Right.
If and when this activity lets up. And I think it's more of a win.
I hope, just for the sake of everyone's sanity, that maybe and I know it's not a prediction, but maybe your theory that the window for this sort of diminishes, between the next OPEXs. I kind of hope, for the sake of, just everyone's sanity, that you're right.
Yeah.
That it does calm down, because it is a bit silly. Even though I'm not a perma bear, I want the markets to go up, but I want them to go up in a sustainable way, because I'd like to retire one day.
And for the right reasons. For the right reasons. I mean, really, we need to see companies doing better on their earnings. This year so far, companies that have missed earnings have had a bid on average, if we look all of them in a composite, and companies that have beat earnings have dropped. And that's unusual. Companies that have been firing people, and no company wants to fire people unless they have to. They've been getting a bid as if that's somehow bullish for the stock. They're losing talent, brain share. Doesn't mean that they're not cutting fat. I guarantee you they are, but it's you can't get that all back together. And another thing that I wanted to just speak about, Aisha and I were speaking earlier about this whole thing, and one of the things that she said about the Fed that I found very interesting is she said that, small and medium-sized businesses are all on revolving lines of credit. So the cumulative tightening impact of the Fed on them is going to be much worse than these larger corporations that have refinanced their debt, the maturity wall out to like 2026, right? So there's a complete difference between the small and medium-sized businesses and how much this tightening is going to hit them. They're the largest job creators versus the larger companies that'll probably be able to weather the storm a bit better. And that does have, economic impacts, as does the same on the average consumer. Sure, mortgages are the largest debt most Americans have, but they also run a lot of revolving debt. In fact, the most they ever have before, and rates are rising on that. As the Fed raises their rate, the prime rate goes up. Credit cards are based on a certain variable plus prime. So, we are seeing a consumer where 40% are having trouble paying their bills and 2/3 are living paycheck to paycheck. So do the math in an economy where the consumer is 2/3 of any durable GDP growth. And the last GDP only had 0.2% of the 2.9% from consumption. There's already signs that the consumer is ailing. So yeah, this is a market that is far removed from anything healthy. Earnings are likely to further weaken. I'm not a perma bear either. I love being an optimistic person, but I want to also make investments that I can sleep at night with for the right reasons in a right market environment. I'm great trading the short-term, medium-term action for, these types of counter trend rallies. I have no objection to that, but I like to be cautionary because my long-term view is still quite concerned. I don't think we're out of the woods yet by any stretch of the imagination. And wherever we look, we're seeing signs of that.
Yeah. I mean, if you're concerned about sleeping at night, have you ever considered zero DTEs? You could be flat at the end of the day.
I have and I do. I do.
I'm just kidding.
No, I do. I do actually think zero DTEs are a necessary part of learning how the market trades. You don't have to trade them yourself, but watching them is really, really important. Particularly,
and I don't recommend that anyone does trade them themselves. I'm making a joke, but there's always a little truth in every joke, and in this one, it's probably the truth in it is the banks are, or I shouldn't say just banks, but larger institutions are feeling much the same way. You can sleep at night because they're not holding this on their books. So what's true for one is often true for many.
And I think that, there's always room in the market to learn something new. And so the reason that I think it's important to look at zero DTEs is if they're such a driving force of price discovery and we're intent to trade the market over various time periods, understanding the impact that they have is really important to understanding why the market may be moving like it is. And we see very strong suggestions that this is the primary driver of short-term price discovery, but there's more. And I'm going to get into that. Before I do, though, I wanted to talk about how retail is kind of seems like they're being used for exit liquidity yet again.
Yeah, this chart makes me sad.
It does because, they're not in the options, right? So we know they're not the big mover of price, but they're probably getting long here. We don't know whether this volume's long or short, but I can look at the flows and I'll break them down in one of my subsequent write-ups. But net, what I've seen leading up to this is that people have been buying single stocks and ETFs a lot more. And even piling into ARK. Even last year, retail was net plus $2 billion on ARK, which makes me sad because it dropped below the COVID lows last year.
I agree but let me clarify my comment. I'm not sad seeing people get long. I'm sad looking at the chart that this is percent of market orders by market volume, correct?
Yeah. That's what I'm saying is that, look, this chart...
Retail, please stop using market orders. We're better than this. You got to be better than that because you are going to be exit liquidity doing that.
Yeah, but the overall, this is just overall retail market participation, and most of them are going to use market orders anyway, but this is just the overall composite of retail's participation in the market. And they are a very sizable component, jumping up to about 22.5%. And that makes me sad because a lot of people are basically going to be holding very light bags soon. Look at what happened with the firm after hours. Buy now, pay later, kind of became buy now, pay never in terms of what's going to happen with the return on investor capital for this company. Yeah, they beat, but it doesn't matter. The company is broken, and Apple has released a competitor or is working on a competitor for them that's probably going to be pretty devastating because it'll integrate with everyone's iPhone and Apple account, and it'll be available anywhere they want it to be. I just have a lot of concern that we're seeing here that's, there's signs that point to institutions are propping up the market. They're juicing up the prices of their assets. They're also making cash that they can settle at the end of the day so they don't have to report their positions because they're not technically new positions or changes. And at the other side, retail seems to be getting longer and longer this market at a time where it's probably the most risky it's been since January of 2022.
Yeah, my bad. I thought this was literally a chart about percentage of orders as market orders.
No, you're
That's the
good.
part that I was commenting on makes me sad.
That's
Because
already a thing we should talk about anyway, though.
I don't think
we already
anyone
know.
should ever use market orders unless
Yeah,
you
we
need
already
to
know
get out.
that most people use market orders. We already know that.
That's maybe we'll address that in a separate video because that's just sad in and of itself.
But just don't do that. Just don't do that. We'll address it and we'll have a whole thing about it. I'm sure most of the people listening don't. But for anyone out there that does, please just Google what a limit order is, and we'll talk about that more soon. And always use a stop and don't use a limit stop. That's where a market order makes sense. You got to have one on a stop or you'll get gapped right over. That's a whole other conversation. We'll talk about that as we continue to talk about risk management. But for the here and now, please be very careful out there if you're aggressively long, thinking this is a new bull market. I can't predict the future. Horse can't. None of us can. But what we can see is we can put all these pieces of the puzzle together and illustrate that there's fatter left tail risk now than we've seen in a long time. Now, let's talk about some of the other drivers here, what's really going on, because I think it's important that we give kind of a nuanced composition. This is a really interesting chart. Here's a chart of margin debt in red. We can see the deleveraging. We can see the strong positive correlation that deleveraging tends to have with the market. And we can see where we are now, where it's kind of like, hold on, I thought people were selling. What's going on? Why is the Wilshire 5000, the broadest measure of U.S. stocks, rallying as the world is deleveraging? Well, I think a reasonable explanation would be what we've been talking about, that options are driving price, that people are choosing to employ leverage in different, much shorter dated venues because the cost of carrying this margin overnight has surged. So why would you do it anymore when you can play the market as we see institutions playing it? But it does mean there's more structural vulnerability because the amount of actual longs in this market are shrinking.
I mean, there's truth to it. I saw that chart as well. I kind of want to see January's print though, if it comes up, because there is a little bit of a delay there, just in fairness to people. Yes. If it comes up, I do think that takes a little bit of the anxiety. But if it gets worse, then the spread there is, in my opinion, would be concerning.
Yeah, we're waiting for that information to come out. We'll definitely share it as we have it. I do think there's other elements that explain the gap in that chart too, outside of the options, and we're going to dive into those here. One of them is central bank liquidity. And we can see the Fed and the ECB have been, as they promised, reducing their total assets. But the Bank of Japan, would you look at that? Kuroda just can't stop. He's got this printer. He got all the new toner cartridges for it, and he's just running it back down to no toner at all. He's printing so much yen to add to their sovereign markets because their sovereign markets have become a bit of a basket case. The Japanese government bond, and we're talking in particular about their 10-year, has been the subject of massive amounts of intervention. And all that liquidity has to go somewhere. And it's certainly not going to stay in the Japanese bond market, particularly when some of these issues are actually oversubscribed, where the Bank of Japan owns more than 100% of some of these issues, it's insane. It's insane. And I know they're trying to keep the 10-year at plus minus 50 bips as a part of expending all of this liquidity to sort of control their yield curve. But I'm going to tell you right now, the time for that to be tenable and possible and sustainable is behind us. And we do have new leadership coming into the Bank of Japan this April. So we'll see what they say. But, eventually the country's going to have to make a choice between its currency and its sovereign debt market, or some compromise between the two. And I think that that's a choice that maybe we'll hear more about as we get into the second half of this year. But in the here and now, the Bank of Japan has been adding a lot of liquidity to the global financial system, and so has the People's Bank of China. Now, that's the December reading. I'm sure it's risen even more in January. Their data is even more lagged. But the picture that this chart paints is an important one because it explains another part of that gap in the margin debt, that liquidity is coming in from other sources. There's also good old Janet Yellen. Grandma has been spending a lot of the Treasury General Account into the financial system because when the Treasury is confronting a debt ceiling, it will pay down some of the bills from this account. Other reasons may exist as well. Trying to reliquefy a fragile banking system come to mind. And what happens when the Treasury spends this general account is it ends up in the deposits of banks and adds to their reserves. Those same reserves they don't seem to have enough of. Pretty convenient timing. The Treasury has been spending approximately $150 billion a month of their general account. The capital winds up in those deposits. It adds liquidity to the financial system. And this, combined with the last chart, has been a major offset for the Fed's QT over the last period since, wouldn't you know it, October, right when the market bottomed. So sometimes the macro does make sense with price discovery, but we got to look at everything. We can't look at, pieces of the puzzle in a vacuum and try to make a conclusion about where price may go. We have to look at the total liquidity in the global financial system to draw a more well-informed conclusion as to why we're seeing, because the Fed doesn't want necessarily what's being seen, but if there's more liquidity coming into the global financial system than going out, then that's going to cause a bid for risk assets and for debt and other things. And if the Treasury is sitting there spending $150 billion a month and QT is $95 billion a month, they've already more than offset QT. Then you add the Bank of Japan and People's Bank of China impact in that, and we can see where this is going. So it's interesting because in essence, they are sort of fighting the Fed, and the Fed's policy impacts are having less of an effect than they would if this policy was allowed to exist, without this sort of fettering. And I don't think Japan has much of a choice. They are doing everything they can to forestall the inevitable debacle in their bond market. And the People's Bank of China is moving cautiously, but they're adding liquidity because their economy is reopening, and they're going to, quite frankly, need it to try to sustain any growth after their GDP pretty much flatlined.
Cheers on the coherent narrative here, tying that back to the distressed banks. I mean, this is really well done.
Thank you.
Your research is impressive. Honestly, I'm thankful that you're sharing it with us because it's thought provoking, right? Even if you're just an idiot trader like myself, this is stuff.
You're not an idiot trader.
Well, but this, I'm not a macro guy, and I'm sorry that you have to be presenting this to someone like myself. But
don't be sorry. This is our audience. We want to help as many people.
I'm making
as
jokes here. I'm making jokes, and that's your strength, is explaining this stuff in a way that's easy to understand. And I think the narrative that you're painting makes your theory about some of the activity we're seeing make a lot more sense.
Thank you, my friend. I appreciate all of that. And I think it's really important for us to keep every one of our members well informed based on everything that we can find. You do a fantastic job covering the technicals and what's going on underneath the surface in the markets. And I feel like, for everyone out there, whether they're a day trader, a intermediate term or swing trader, or an investor, covering this stuff is important. Having a well-rounded base of information helps us to have a better understanding about why what we see is happening, and also how the situation may be evolving. So I want to just do my best as a content creator here at Traderade and a partner here to provide as much information as I can and as much original research as I can. And this is something that's been intriguing me for a while, and I've been sitting here in the background putting together a lot of these pieces, researching them, discussing them, and I finally felt like I had enough information to present a compelling case. I remember we talked about it the other night, and you said, this is something we should really do. And I felt like, you're absolutely right. It's finally time for me to come out with all this information. And look, I know people out there are going to have all sorts of varying ideas and questions and feedback. So please leave that in the comments section, or if you're on the Discord, ask it in the questions channel. Traderade is all about community education. We're all about being a publication that embraces the idea of helping you find your edge, becoming more consistent, but also understanding more about the inner workings of the economy and the market and the financial system at large. So what we've got here on screen is the total assets of the Fed, ECB, and BOJ. We don't have the People's Bank of China, but you get the point. That blue line shows the size of their balance sheets. And wouldn't you know, it's just perking up there in January, just as the market was. So the liquidity in the financial system in aggregate has been improving, even though the Fed has ostensibly been tightening. And this starts to explain why things have been so weird. Because if we look at things in the vacuum of the US being sort of isolated and the Fed being the purveyor of liquidity, we could say, well, why are things going down? Why aren't things going down like they should? They should be going down much more. Well, when we put all the pieces together, we find that actually it's not that simple. There's a lot more moving parts, and the role that Japan and their financial system plays, that China plays, that Europe plays, quite frankly, is key, as is the role of our own Treasury. Combine all of that with all the options buying to add leverage during a time where the cost of capital is high, and we can see why markets have appeared to be so buoyant. Now, this also presents the question of time. How long can this last? Well, now we know where to look. And yes, some of these indicators are not available every 2 seconds, so it might not be valuable for day trading. But these indicators are things that are released regularly. So it gives us an idea as to where financial conditions might be changing, like the Bloomberg Financial Conditions Index, the Goldman Sachs Financial Conditions Index, and the publicly available Chicago Fed National Financial Conditions Index, which is a very broad measure of over 100 different instruments. So it's something that you can just go to their website and view. That's one place to look. Yardeni, his website at yardeni.com, looks at all of this stuff. They have tons of great charts on margin and on central bank assets that are updated as the data comes out. And there's a variety of other sources, including your broker. If you have the ability to look at the S&P options chain, you can see where the activity is happening for today's expiration, similar with single stocks and ETFs. So we now have some of the tools, just like the Treasury General Account's public information on their website. We have some of the tools that we can use as retail to map this out in a way that makes sense. And in doing so, we're able to start to find a bit of an edge, something that we can use that, gives us the bigger picture view. And charts are great and fundamentals are great, but when we add both of those together with macro and we get the complete picture and we can see some degree of coalescence, that's really the best bet. And that's one of the reasons why we do what we do and why the composition of our team is what it is, where we have experts in, each one of these areas really looking at this and trying to share this research. So on screen, what this suggests is that really we need to track central bank liquidity, the Treasury General Account, and options activity to get a sense as to when things are stalling and maybe when things start falling. And then also on a more delayed basis, we can look at FDIC and see where the unrealized bank assets or bank losses are in terms of their total assets. And so we have now information that, typically doesn't get discussed. You don't hear it on CNBC that much, if at all. You don't hear it on Bloomberg that much, if at all. But you can now find and bookmark these resources and allow yourself to do this kind of research if it interests you, or if you just want to try to find what's going on and how that may influence price. The last slide I have is be careful what you wish for. The last times that the Fed pivoted didn't end so well for the stock market. Most of those 3 and 6 month periods ended with negative returns. Even often the 12-month periods did after. And you've got to ask yourself, well, why are they cutting? Well, usually the Fed is cutting when something not so great is happening. In fact, that's almost always why they're cutting. And we see that Fed funds futures are pricing in cuts towards the end of this year. Well, if history is any guide, if they are cutting, that means that people are probably anticipating something not so great happening, because people in Fed funds futures are pretty sophisticated speculators. And if they're saying, look, we think that, the Fed's going to go easier than they're saying, and that they're going to cut towards the end of the year, that suggests that maybe Powell's nervousness is warranted. And if it is, I know a lot of people out there are looking for the combination of a soft landing and a pivot. It's a kind of bit of a contradiction there. I don't think that if we get a soft landing with high rates that the Fed has any motivation to pivot. But I do think if we do have a pivot, it's likely to be because there's some kind of economic or financial calamity. And I'm not calling for one, but I do think the likelihood of one is increasing the longer that we have these high rates and eventually liquidity once again being drained from the global financial system. So when we talk about, well, the pivot's my turning point and that's where the bottom is, it's possible. This time could be different. I don't doubt that at all. But most of the time it's not.
Right.
So that's what I've got. It's a lot of fun to present this to everyone. I hope everyone enjoyed it. And I wanted to, just take an opportunity to thank everyone for supporting Traderade as well. This kind of research wouldn't be possible without your support.
Well, I'm a little speechless, and I don't know how I could possibly follow that, but I do want to commend you on the research and the narrative all the way through from start to finish. I think this is outstanding work. Very interested to see how it pans out in the future, because these are the types of things that we always know at some point what was really going on. You're right. It takes time, but eventually there's stories, there's books, there's movies, there's all kinds of stuff that explain what was happening during periods of unusual financial activity. And I think we're at a point now where really no one can deny the effect of the options market, especially the short dated options and the usage. And I think this is one of those things that will be studied down the line. People will say, well, what was happening? What was driving that? How did that even come about? And I think to date, you've just presented here the most coherent theory as to why this activity is taking place at an institutional level. So for that, I commend you, because I think it's outstanding, and I can't thank you enough for sharing it with us.